The S&P 500 ended the first quarter down 20%, and a collapse like that is generally bad for investors. Often, it's terrible for pension funds. Tell us how you're making out.
Well, Eric, as you know, we look long term. So fiscal year to date, that puts the broad U.S. market down about 16%, which is tough because it is a big segment of our portfolio. But we have diversifying asset classes. So we have a large segment that's invested in fixed income, which obviously has rallied during this time. We also have an asset class that's pretty unique called risk mitigating strategies. Strange name, but basically it's an asset class of strategies that don't correlate with the broad equity market. So that in turn is also positive over this time period. So that's helping balance out the difficulty we're seeing in the equity markets.
You've steered CalSTRS through quite a few crises in your 20 years as the chief investment officer, aside from the obvious, and those things are evident to, I hope, all of us. Tell us what's most remarkable about this crisis.
Well, Eric, it's the speed. That was only barely, 40 days ago that we were at all-time highs in the U.S. equity market. So it's the sheer speed that we saw. It's difficult to pin that down of what caused the sheer ferocity of the market decline. There was a lot of leverage in the system. Certainly a lot of people with high-frequency leverage trading that must have caused that decline. It's been nice to see in at least the last week that we've returned to some normal semblance of at least a up 1% or down 2% type of activity. And I think going forward, we'll see a market that's maybe a little bit more stable than those just record-breaking moves that triggered all the circuit breakers. Just unheard of to see 20%, as you said, over a quarter. But really, all of that was principally just in the last 3-4 weeks. So just a dramatic shift. That before, in 2008, it was a decline, really over 55 trading days, the bulk of it. But to have this occur just in a matter of 15 trading days is so difficult.
Chris, you mentioned that CalSTRS is a long-term investor, but if markets don't recover to prior levels soon, and the consensus is that they're unlikely to, what kinds of difficult decisions do you face having to make?
Well, number one, pension plans are very long-term, so they smooth their returns. They don't take them at a particular point in time. We're going to use a 3-year average smooth, which even that's a bit short-term. The 3-year numbers are weak on the market now that we've seen these losses. But when I look out at June 30, where we'll stop our fiscal year, that just seems so far from now. We have to get through April. This stimulus package will start to take effect. Hopefully we will see a peak in the number of infection cases in the USA. And maybe things will actually be getting back to normal by the time we get to June. And many people are predicting a very strong third quarter. So when I look past that one time period, I think we're going to be okay. It definitely makes 2020 a difficult year in the funding plan, but we expect to have potholes every once in a while in the market. And so our long-term plan will actually stay pretty close to staying the same course.
Chris, CalSTRS is a significant private equity investor. What happens when private equity firms call on the capital commitments you've made to them at a time like this?
Well, cash is king. And right now we have not heard many of them calling on the future commitments that we've made. They've mostly drawn and told their portfolio companies to draw on their lines of credit, which we think that's a smart thing to do to maintain liquidity. We will see some declines, but those won't really show up in portfolios until probably out in June, just because of the lag that private equity has in its valuation process. It typically is about 70 to 60% of what the equity market does, but it also creates an investment opportunity. Obviously, the oil area is seeing a massive recession, but then clearly the hospitality, the restaurant industry, there are going to be investors in those areas that are going to need infusions of capital, and that's where private equity will be best positioned to come in.
Is that to say that you see this as an opportunity to shift allocations, say, to more toward opportunistic credit and distressed debt as well?
Well, we're having those discussions. It's too early to say that that's going to be a large opportunity compared to where it was in 2008. We already have some allocations out to those types of managers, and I think private credit was such a large growing area in 2019. Clearly, you heard and you reported sometimes that they were without covenants on some of their loans, so those could be difficult times. And anybody that was highly leveraged going into this is going to have a big difficulty trying to bridge their financing. So there will be opportunities. I think this is actually a stronger, but a shorter-term recession than we had in 2008. So I think we'll see it recover more quickly and less opportunities in those distressed debt areas.